Dan Celia.
There isn't going to be a default. We have enough income coming in every month to the federal government to pay the interest, to pay Social Security.
Appreciate everything you do. Love your ministry.
Your personal economy.
For 30 years, an E-bond earns. After 30 years, they earn nothing. So if you have anything over 30 years, it's not even earning what it might in a money market account.
Financial issues that you need to know.
Spending's going to rise $9 trillion over the next 10 years. The sequester takes $1 trillion off of that. Spending still goes up $8 trillion over the next 10 years.
Aligning reality with truth.
For some reason, these Republicans, along with many Democrats, believe that continuing to run up the debt on our credit card is okay.
God bless your ministry.
Now, here's your host, Dan Celia.
Welcome back. You're listening to American Family Radio Network Financial Issues. I'm Dan Celia. It's great to be here. And we've got a number of things that we've already talked about. I'll just recap real quick. I'm not going to spend a lot of time on it. I mean, obviously, we saw what the markets did yesterday. Right now, things seem to be relatively flat, slightly positive. So we'll see where things go today. But the big issue is going to be Russia, Crimea, the Ukraine, all of that. That is going to be the big issue. That's what we're going to be looking for. That's what I'm going to be looking at going into Tuesday or Wednesday. We see the administration has drawn another line in the sand. There's no credibility in this administration drawing any lines since it's meaningless to them. And they are not, and cannot negotiate. I'm talking about our administration, cannot negotiate it from any point of strength. Sad to say, we have no strength. We are negotiating. We've got one great lever against Russia, and it's the economy. It's economic, true, not the phony. We are going to see phony economic sanctions, or I would say economic sanctions that aren't in fact sanctions at all, come Tuesday or Wednesday next week if this referendum that Russia has orchestrated goes through on Sunday, and Russia does nothing about it. So we're going to see some sort of phony economic sanctions to save political face. I get that. I understand that. But the fact of the matter is we're not going to see true economic sanctions because those economic sanctions to Russia will kill our economy. And that goes for Europe as well. So though we are together on this with Europe, they are in the same boat we are. See, we, at some point in time, I think there is a book written about this. Oh, yeah, it's the Bible. That reminds us that we can be a slave to the debtor. See, we can be a slave to our debt. Europe and America taking on $100 trillion worth of debt globally. We've taken on $100 trillion worth of debt. That's about $60 trillion more since 2007. It's an enormous amount of money. We live in a country in America that has over $100 trillion by itself in unfunded liability. We have 18 trillion or quickly approaching 18 trillion of debt on a regular basis and growing quickly. The idea that we can risk economic sanctions to Russia is ludicrous, isn't going to happen. So we have no leverage. Now, if it comes to a place where it's either put boots on the ground or have true economic sanctions, I hope we'll choose true economic sanctions. But be prepared because the market's going to come down considerably. And right now, this market is all over the place. I said in January 1st, end of last year, that we're going to see wild swings, a lot of volatility in the markets this year. In other words, the ups will be stronger, the downs will be stronger as well. There's going to be much greater swings in the market throughout this year, and I believe that's going to continue. All things point to a bad market, bad economy, and it seems as though we are seeing more and more corporations, corporate America, insiders. I don't know if you read my piece on insiders predicting the market, but you can go to christianpress.com, christianpress.com, if you want to read it. It's on the front page right now. It was in my newsletter last week. So you can check that out, but without me going into it. So read that and you'll get a better idea, a little bit more of an idea of one of the things that I look at and where I'm coming from on all of that. We're going to get right back to the phones. Before I do that, Mary had asked a question, a caller had asked a question about H.R. 4646. I hope that's the right question, the right bill that she asked about. Is it? Okay, Devin says yes. H.R. 4646 is a bill that the Obama administration tried to put forth in 2010. It didn't get any legs. Nobody was going to go for it. It's not going to. It's not something we need to be concerned about. So I don't want to spend a whole, well, here's what we know about H.R. 4646. What it does, and all these things do this, they give us a glimpse, and I say this all the time, of the ideology in Washington. That's what this does. And the ideology in Washington, if you look at H.R. 4646, is let's tax everything 1%. And that was the idea of this bill. So anything that can remotely be considered a financial transaction, using a credit card, using a debit card, depositing money in a bank, withdrawing money from a bank, your automatic check, you know how your paycheck gets automatically deposited in the bank. Anything, your debit card at the department store, grocery store, wherever you use your debit card, gas station, all that. Anything that resembles a financial transaction needs to have a 1% tax on it. And that was the plan. That's what this was all about. It was going to have a 1% tax on it. And there are a lot of rumors out there. There's a lot of blogs out there. There's a lot of conspiracy theory things out there that, you know, this is already happening. It's going to happen. No, it hasn't. It didn't get passed. It didn't see the light of day. So I don't think that we're going to see this happen. But we certainly could, because Republicans and Democrats alike, there's one thing they have very much in common. Two things they have very much in common. One is they love to spend money. They don't care what it's on. They love to spend money because that gives them more power and more control, and they love that. The other thing that they love more than anything is their job. And the last thing they want to do is have to go out and get a real job. So the other thing that they love is politicizing everything and coming together, and no matter what they do, they've got to protect their job. Well, the beauty of this bill is it accomplishes one aspect of what they love to do. They can continue to spend money because they have all this money coming in. The downside is that it's going to hurt them keep their job. They don't want that. So we have that going for us. So we'll have to wait and see how all that shakes out. Let me go back to the phones, 866-300-9298. You're listening to Financial Issues. I'm Dan Celia. Let me go to Russell. Russell's calling us from Alabama. Hey, Russell. Russell?
Yeah, can you hear me?
Yes, sir.
Mr. C, love your show, and my question is, I was interested in penny stocks. Do you have any advice? Just wanted to get your take to it, and I will listen to you on the radio, and I sure appreciate you taking my question. Thank you, sir.
Thank you, Russell. Yeah, here's the thing, Russell. I would say, I'm not, I don't track penny stocks. I mean, the only ones that I might look at are ones that have become penny stocks in the sense that they've gone from, $15 and they were on my radar screen and I was tracking them and recommending them, and they're now worth, 10 cents. So I may still have some interest in looking at those. Here's the thing about penny stocks. People, when you get these newsletters and these blogs, you're going to make a lot of money. It's 10 cents a share and it's going to go up to $12 in 5 years. You're going to make lots of money. And is it possible? Sure it is. It's all very possible. Is it likely? Extremely unlikely. That is a very low percentage of those companies that do that. Very low percentage of companies that happens to. The other thing about penny stocks is the guys that make money on penny stocks are the guys that started the company. And they're the ones that make all the money. Because it's penny stock and you can buy so much of it, that it's very easily controlled by those that are in power of that company. So it's a very dangerous thing. They can put out some news reports. They can put out some projections. People are going to flock to it a lot quicker than you'd flock to DuPont stock because it's so cheap. You put a lot of money in. So it's not people putting tens of thousands of dollars in. It's only people putting $500 in, but the volume of people putting in is dramatic, and they can pick up a lot of money. Stock goes up. Everybody that put the money in is very, very happy because they see the stock going up, but it doesn't last. And what we sometimes see are those on the top starting to sell at the very time that is starting to happen, where it's going up, and they're profiting from that. So I don't like them. Listen, I think that I would rather see somebody put $500 and buy, a few shares of a good, strong, $5 or $10 stock than I would. I mean, think about Ford Motor when it was at $6 a share and $10 a share. I would rather see you put a little bit of money in an expensive stock, because remember this, how many shares you buy is irrelevant. It doesn't matter if you buy a cheap stock, a penny stock, and you can get a whole lot of shares for, $500. What's important is your return on the $500. So if the penny stock goes up 20%, you make 20%, right, on your $500. Regardless of how many shares you have, you're still making 20% on your $500. If you own Ford Motor or DuPont or a big company, and it too, you put $500 in, and it too goes up 10%, you made 10% on your $500. You didn't do it on as many shares, but you still made 10% on your $500. And it's a lot safer. It's not going to go bankrupt. It's not going to go away, and I'd rather see that. Let me go to Nip in Mississippi. Hey, Nip.
Yes, Dan. I am now retired, and I was wondering what to do with my 401 and retirement money.
Okay.
I was wondering if I should just put it in an IRA where it's safe and I can access it, or if I should maybe invest in something like Pacific Life, where there's supposedly a guaranteed 2%.
Mm-hmm.
That's my question.
Okay, that's a great question, Nip. Here's what I'd like to see you do. And is this money, Nip, before you go, is this money that you're going to have to draw from to supplement your income?
I am. Will be 69 this year, so I'll have one more year, maybe a half.
Right.
I'm not sure if it's 70 or 71.
70 and a half, yep. Mm-hmm.
Yeah, and then I'll have to start drawing a certain amount.
Okay, so what
I won't necessarily need it immediately.
Right, but you'll need to withdraw it anyway, whether you need it or not, and then you'll shift it over to savings. Yeah, I would say this to you, Nip. I would like to see you move it into an IRA. That would be my first preference, that you open up an IRA account somewhere that you can kind of control. You can keep things liquid. I don't like the idea of being any kind of annuity. That's what Pacific Life is. In a commercial annuity, I'm okay with some of it in a charitable gift annuity to generate some income, but I wouldn't be okay with it in a commercial annuity. I don't like anything that has surrender charges, anything that's going to lock you in with that. With the majority of that money that you can't get at relatively quick. And I don't like buying product where I understand you're guaranteed a minimum of 2%. And the question that I tell everybody to ask, and I would say it to you too, ask what the 2% is on. In other words, being guaranteed a 2% and not going below 2% is one thing. And that's good. But the question is, will my money, so you put, let's say you have, $50,000 in this IRA, you put it in there. Are you telling me, Mr. Pacific Life, that my $50,000 worst case scenario is going to grow by 2% this year? Next year, worst case scenario, my $50,000 is going to grow by, now my $50,000 plus the 2% from last year is going to grow by 2%. If they put that in writing to you, then I would do it. But I still don't like it being tied up and not being able to get to it without surrender charges. But if they put that in writing, that's fine. But the 2% guarantee may exist, but your principal may have the opportunity to be exposed to markets and fluctuations on the downside. And you need to be very, very careful about that. Financial Issues, I'm Dan Celia, 866-300-9298. We'll get right back to phones right after this. Hi, this is Dan Celia from Financial Issues. You know, I don't talk enough about estate planning, but let me just remind all of you, if you've got a complex situation, maybe you're about to receive an inheritance, maybe you have appreciated assets, homes or stocks or other valuable assets. You want to try to get the best tax situation you can. Make sure you do an estate plan. Would you call the AFA Foundation? 800-326-4543, extension 345. Tell them that you feel you need to sit with Dan or someone else to go through your plan. We're happy to do it. Don't get bogged down in all the details and options. Talk to us first to see how we can help sort it out for you. Call the AFA Foundation, 800-326-4543, extension 345. Call today. The opening statement in the Constitution of the United States says this, that we, the people of the United States, in order to form a more perfect union, establish justice, ensure domestic tranquility, provide for the common defense, promote the general welfare, and secure the blessings of liberty. I don't know what part of that we don't get anymore. That was written by men who cared about this country deeply.
Financial Issues with Dan Celia.
Let's get right back to the phones. Financial Issues. I'm Dan Celia. Thank you for being with us. We're here every day at this time, and we're so grateful for all of you being a part of it. This is our second hour of Financial Issues. Let me go back to the phones. It's Friday. On Fridays, if you're a new listener or viewer, you're just joining us maybe for the first or second time or just started this week, every Friday we do. Now, we always take a lot of calls, but on Fridays we try to take a few more and try to get to them early and stay with them. And that's what we're going to do. We're going to go back to the phones. Let me go to Ed. Ed calling us from Texas. Hey, Ed.
Good morning, sir. How are you?
I'm well.
Thank you for your I love your show, and I love American Family Radio. I have a question about my 401 pensions, and me and my wife are both 55, and I work for a company that really doesn't have any place I can put my money securely. It's all in. It seems like it's in radical funds.
Mm-hmm.
Let me kind of break down what I got.
Okay.
I've got like $50,000 in a 215 target fund.
Uh-huh.
$15,000 in a 2020. We have a stable fund. I got about $7 in that. I got an intermediate term bond fund. I got about $17,000 in that. I got about $40,000 in large cap equity, which I guess is S&P.
Uh-huh.
$10,000 in international equity, $30,000 in the Russell 200, and about $14 in company stock.
Okay.
And then I have about $150 in a 403B Get Fund, which was a fixed plus.
Okay.
And I have about $45,000 on hand cash, but we're fixing to spend $15,000 of that and get completely out of debt, which will leave us $30,000.
Okay.
My question is, with the company that I'm with, it has all those different funds.
Right.
Should I be getting out of those and moving them to something more stable?
Yeah. Here's what you should do. So you're pretty conservative. You don't want to take a lot of risk at this point.
Yeah, we're 55, so we're getting close, but not really close. You know what I mean?
I would take, if you want to stay very conservative, which is fine, I would probably have the majority. I'd have some money, maybe 30% in the 2020 fund, 2015 being a little bit more conservative. But I would have about maybe 30-40% about 40 or 50% in the 2020 fund. And then you didn't mention this because you're not in it, but I'm wondering if they offer a short-term bond fund. They offer an intermediate bond fund, which you're already in, but do they offer a short-term bond fund? And if they don't, okay, so the best you can do is conservative for the whole portfolio, the best you can do is their 2015 fund. I was going to suggest that you put the balance that you don't have in the 2020 into the short-term bond fund. That's going to give you a little bit more opportunity to preserve some of your principal. But in light of that, I'm not a fan yet of intermediate bond funds. I may be by the summer or the end of this year. I think the intermediate bond funds are getting very close to a bottom, but I'm still a little bit too concerned to jumping into any kind of intermediate bond funds because all the bond funds are going to take a hit if interest rates go up. So they already have. I warned everybody back in April of last year to get out of them, and many people did, and I'm not quite ready to get in yet. So the only thing you've got there that you can do is the 2015 fund. Unfortunately, the conservative portion of the 2015 fund, they're going to consider conservative portion of the 2015 fund is probably going to be that intermediate bond fund. But you can get a list of what that is. Whenever you do a life cycle fund, and I say this for everybody, and by the way, Ed, everything else you're doing is fine. I wouldn't touch anything. That's great. I'm all for using some of that cash you have for your debt. I think that's a great idea. I'm okay with that. Everybody though, when you have a life cycle fund, you defeat the purpose of a life cycle fund by being in the life cycle fund and being in some of their other allocations. It really, the life cycle fund is designed to include all the funds, but in a 2015 fund, they might have more large cap equity in a 2040 fund, they'd have a whole lot more large cap equity than a 2015 fund. So, that's where I think you ought to be. The only thing I would say to you on a dip, if the market goes down, it stays down, we get back into a recession. If that happens, or not if, but when that happens, then I would suggest, if you can remember, to take about 20% of the monies that you have there and move it over into the large cap equity fund, if that happens. So, and I think if you do that, I think you'll be on the right track, and that'll help you out. Unfortunately, though, that's the downside. The upside to the 401k, obviously, is you're getting a match, you're able to save. It's pre-tax dollars and all those kinds of things, and I get that and understand that, and we should all participate in those, particularly if there's a match. The downside is that you have very little flexibility. Someday that's going to change, because let me tell you, I shouldn't even say this, but I know I'm right on this, and I've only said it a couple times. I've said it in board meetings more than once. I said it 3 weeks ago. I was speaking to a fairly large company's board, and I said it to them, and they immediately, from what I heard that evening at the end of the board meeting, was that they all decided they were going to make that change. One of the number one lawsuits in this country in probably the next 10 and 20 years are going to be people suing their employer for not giving them the proper options to be conservative. And they're going to say, my money would not have suffered like it did had you given me more options. It's going to be the biggest lawsuit in the country. Lawyers are going to be just working full-time around the clock, and companies are going to be getting hammered. Trust me on that. If you're a company and you're listening to me and you've got a 401k, you better rethink and stop listening to your advisors who don't want you to offer money market accounts and short-term bond funds. They don't want you to do that because it's of no benefit to the mutual fund company, so they don't want you to do that. It's not to their benefit. But you better stop listening to them. Start thinking practically. You can't, whether your employees use it or not, it's a whole nother story. But you better offer it. You better offer it so that your defense can be, we don't manage, we don't make suggestions, we're not in that business. All we do is offer opportunities for them across the board. So It drives me crazy. It is no sweat off their nose to offer a money market account. It's only sweat off the financial guy's nose because they don't want money going into their money market account. So they don't want to offer it and they never talk about it. But it doesn't matter to the company. And there's going to be companies that are making huge mistakes by not doing that. Let me go to Zach. Zach calling us from Illinois. Hi, Zach.
Hey, this is Dan.
Yes, sir.
How you doing, sir?
Good.
Hey, I've got a question for you, and I'll make this quick because I've got a meeting I need to go
Okay.
to. But I'm interested in on your opinion about there's a lot of interest going on in the Crimean region, Ukraine, their revolution, and now Russia's involved. However, I never heard a lot about why it was important to get involved, especially when there were similar things going on across the world, especially in Venezuela, which there's still not a lot of attention on.
You mean getting involved in what way? From a military standpoint?
Well, I mean, we're not involved militarily yet.
Right.
But I mean, we're talking about sanctions.
Oh, I see what you're saying. I got you.
Okay. Well, we made a choice to not get involved with Venezuela during their revolution. We're making a choice to get involved with Ukraine during their revolution, and now that Russia is involved in the Crimean region. However, I think this has a lot to do with the European Union's interest to get oil. A lot of that goes through Ukraine. However, I don't know, and no one's really talking about this. The focus is on what's going on there and why we need to do it because Russia is such a bad country.
Right. Yeah, that's a very legitimate question, and I think it's a good one. And you're right, we're not talking about that. I can't talk about it from every. I can give you my opinion on it, and I'm happy to do that, Zach. I mean, my opinion is, and I'm a military person. I believe in military. I believe in peace through strength, and I believe that it is in everyone's best interest, particularly in Eastern Europe, because it's going to impact the Eurozone. Remember that the Eurozone is the largest economy in the world. We always say, well, America is the largest economy, then China. The Eurozone, the 27 countries of the Eurozone, is the largest economy in the world. It's very, very important to, obviously, the global economy. So I think that we need to be very cautious about the spread of communism. The spread of communism, particularly through Eastern Europe. And the spread of communism is never going to be, it's never going to be a good thing for the people that are involved, and it's never going to be a good thing for the global economy. Of course, there probably are some isolated areas in the world that it would make a little difference. But, it goes back, if we look at the Cuban Missile Crisis, why would we have risked a war over Cuba? It's very close to our shores. That strength growing in Cuba as a result of what the USSR was doing at the time from a communist standpoint, 50 miles off our coast, very scary thing, and we could not afford to allow that happen. We couldn't afford to have communist military bases in Cuba. Well, Western Europe cannot afford. They need to minimize that as much as they possibly can. So I think it's for me, it's a very practical reason of slowing down the spread of communism and diminishing the power of communism in that region. And I think that's very, very important. And so the way you do that, I mean, things have been fine with Russia. We're glad if you can say the Cold War is over. We're glad that has happened. But at the same time, we don't want to go back there. We don't need to go back there. It's not going to be good for people. It's not going to be good for human rights. It's not going to be good for global economy. So that's the main reason. I mean, I think that, and I think that when we talk about getting involved, when we talk about sanctions, we talk about all of this thing. It is for the spread of that power to increase across the globe. The ports of the Black Sea are very, very strategic to Russia and China. Very, very strategic. And we don't, we need to push against that if we can. I'm not for going to war, but we need to push against it in every way we can. Let me go to Andrew in Oklahoma. Hey, Andrew. Yes, sir, Andrew.
Yes, sir. Within a life cycle fund like Fidelity 2030 or 2035, can a person reset those allocations within that fund? So you're in a financial services. Can you take a certain amount out and say put it in energy and so forth and so on?
No.
I was hang up and listen to you on the radio.
Yeah. Okay. Great. Thank you, Andrew. No. So you can't. So the way the life cycle funds work is that the mutual fund company Fidelity resets that. They reset the allocations within those life cycle funds. They do that every year. The idea is every year, I think you said 2035 fund. So every year, the 2035 fund gets a tiny bit more conservative. Now, probably not in great strides every year for 2035 fund yet, but the idea is that you can put your money in there, and the concept is, and forget about it, because by the time that you get to be near retirement age at 2032, that fund's going to be probably, extremely conservative. It's going to be a lot in cash, a lot in short-term bonds. It is going to be very, very conservative by the time 2032 or 2030 rolls around. It's going to be very conservative. So the idea is they're resetting on a regular basis those asset allocations within the fund. But you can't say, I was looking inside the 2035 fund, and I see that, can we get a little bit of a heavier position? I see, I want mine to have more Exxon Mobil in it than it does now. You cannot do that. It has to be done. The idea is so that you don't have to do that, and that they're going to do that. So that's a great question, and one I'd never got before and hadn't thought much about. Good question. 866-300-9298. You're listening to Financial Issues. I'm Dan Celia. We've got one line open, 866-300-9298. Hi, this is Dan Celia. I sure would appreciate it if you would consider partnering with me in the Ministry of Financial Issues. You'll have access to my stock picks that come out every Monday, along with my commentary. You'll get access to our conference call that I do with our partners once a month, our alert system that I send out as often as necessary to tell you when to sell a stock, maybe give you some comfort during a volatile time, or maybe when to buy a particular stock. You'll get access to the asset allocation model so you'll know how to manage the portfolio right for you, and much, much more. We sure would appreciate it if in your stewardship you would partner with Financial Issues. Go to financialissues.org, financialissues.org. Partner with us and support this ministry. It sure would be a blessing. Go to financialissues.org, financialissues.org to support the ministry.
The opinions and recommendations expressed by Dan are his own and do not necessarily represent the opinions of this station or any of the show's sponsors.
Welcome back, Financial Issues, 866-300-9298. Let's go back to the phones. Let me go to Bessie. Bessie calling us from Mississippi. Hi, Bessie.
Hi. Hello.
How are you? Yes. How are you?
I'm fine. How are you?
Good.
Yes. I have a question. My husband is turning 62 in June, and he's planning on retiring and drawing his, just retiring and drawing his Social Security and all.
Okay.
And he has 401k on his job, and he's thinking about taking that out, putting it into a checking account or something. And I was wondering what would be a good savings or something to put it in, or is that a good thing to do?
Yeah. Well, here's the thing. If he does that, he would have to pay tax on that whole amount.
Yeah, 'cause I think they said he did have to pay 20% for IRS.
Yeah, so I don't know. I mean, if he's okay paying that tax, I mean, certainly you can pull it out and, put it in something else. But I would be a little concerned. I mean, I wouldn't. Is this money, Bessie, that you guys are going to have to use to supplement your income? And, maybe you are. Okay. Yeah, I mean,
like I said, he will be retiring too, because he's going to draw his Social Security at 62.
And then maybe draw a little bit of this every month to kind of help. Okay.
So I was just wondering, would it be, because if you think about putting it in maybe a bank, in the bank or something, what would be a good savings to put it in there?
Well, the only way that you're really going to keep it totally safe so that it doesn't go down in value is going to be put it in like a money market account until, and then some of it may be in CDs if CD rates go up. That's the only thing you can do to really kind of protect it. But remember, you're not going to make anything. You're going to protect it, but you're not going to earn any real interest, very much interest, if any, practically nothing, not even 1%. You're not going to get much. And the reason that's important is because one of your concerns has to be, or should be, that you are making sure that since you're drawing a little bit of it every month, one of the concerns has to be, am I going to outlive it? In other words, I'm going to be 80 years old and there's not going to be any money to withdraw every month. And so it's important that some of it is trying to earn a little bit so that doesn't happen. Now, maybe I don't know how much money you have. I don't know how much it is. So it's hard to say how long it's going to last. But you need to think about that because you don't want that to happen, obviously, where you're drawing in. And he's retiring, relatively young. So he's, statistically, one of you is going to live to be, 80 or in your 80s and maybe even 90. So you want to make sure that the money that you have has the opportunity to grow a little bit. Now, the only other thing you could do is put it all into something like a charitable gift annuity that is going to guarantee that you can't outlive it. So it'll be, a monthly, whatever the monthly payment is, and you can't outlive that because it's guaranteed to come in as long as you both live, so as long as one of you are still alive. So, but aside from that, that's the concern. So I'm okay. I mean, so to answer your question, yes, a bank would be fine, and you put it in a money market account for now. Maybe CD rates go up in a little bit and you'll have an opportunity to put some in a CD, and that might not be a bad idea.
Okay, and I have one more question.
Sure.
For a child, he's 13 years old, and I had him in the 10-year life pay, but I was actually trying to get a savings for his college plan.
Uh-huh.
And then after I got in there, I realized that wasn't really a great idea. I wanted to know what to do. What can I do about that, or what would be a good savings for? I'm trying to save for college, and he's already 13 years old.
Yeah.
And what would be a good
Well, so you could close that account and take the cash value and, put that into, this new fund. Yeah, I mean, the only thing you can do, because he's 13, he's going to need the money, in the next maybe, 4 or 5 years. He's going to need some of that money. So you can't do anything too risky. But I would probably suggest that you put it in put some of it in a growth mutual fund, a fund like maybe call Timothy plan, and put some in their mid-value. When I say some, I'm talking about 30% of it into their mid-large cap growth fund. But I wouldn't put any more than that. The rest of it, I'd keep where it is, or I'd keep in cash in the bank, because what you don't want to do, Bessie, is put it in something and then have it turn down, go negative or lose money, and you don't have time now to wait it out to make that money back up again, because he needs it. You need to use it to pay the bills for school, and you're not going to have time to let it recover back up to where it was. And that's my fear about doing something too aggressive at this point.
Okay. Do Mississippi have that Timothy Fund?
Yeah, you can get the Timothy Fund anywhere. Yep. And you can call them. You want me to give you their phone number?
Yes.
It's 800-846 7526.
Good one to start with. Okay.
Yeah, that's a good place to start.
Okay.
Okay.
Well, thank you so very much.
You're welcome. Thank you for the call, Bessie. Let me go to Leonard in Alabama. Hey, Leonard.
Hey, Dan, I've got a couple of questions I want to ask you. First one is, are you familiar with hybrid annuities?
Uh-huh.
Second is, I've got a specific situation. My brother, who lives in New York, has been laid off after 27 years on the job, and he's 63 years old.
Mm.
He's got about $225,000 in his pension and 401k, and he needs about $1,200 a month to supplement his Social Security. And he's been approached by a company that is suggesting a hybrid annuity and guaranteeing 7% return with no cannot go down, they're guaranteeing, which would give him the income that he needs. But I'm not familiar with that, and I don't know how to advise him on whether to proceed with that.
Do not do it. It's not accurate. They're not selling it accurately. That is not the case. And here's what I would say, Leonard, to tell your brother. I would tell him, ask him to ask the company, this hybrid annuity company, whichever it was, because a lot of companies offer, and say, are you guaranteeing that I'm never, ever going to lose 1 penny of my principal, and every year I'm going to get 7% compounded on that every year? And that's what's going to happen. So next year I have 7% more, and then the following year I have 7% more than that, or 2%, or whatever they say it is, and I'm never going to lose my principal. And would you put that in writing for me? If they put it in writing, maybe I would do it, but they're not going to put it in writing. And I only tell you to ask him that so that he sees the red flag in that they're not going to put that in writing. That's how he is perceiving this is going to work. And I am assuming that he's perceiving that based on the way they're telling him that it's going to work. But that's not the case, so I would not do that.
Well, if he doesn't do that, do you have a suggestion for what he should put it into?
Well, it's, I would say, how much does he need to draw every month?
About $1,200 a month.
Yeah. So, it's going to be, no matter what he puts it in, you're drawing $1,200 a month. That's over 10% of the, isn't it? Let me think. Yeah. No, it's just under 10% of the amount. So the thing is, you've got to look at it from a perspective that I've got to earn at least that, obviously, every year. I've got to earn that much, because you don't want to be dipping into principal every year, or it's going to go away and you're not going to have anything. Now, I think you can probably do that, but you need to develop. I can't say specifically, but I'll give you some ideas. You need a very well diversified portfolio. So he should have some utilities that are paying, decent dividends. He might have a preferred stock that's paying 6 or 7% dividends. he may have. He's going to have some equity stocks, some good solid stocks that are going to give opportunity to growth. So you're going to have a pretty good mix, so that. And I don't mean you have to make that every year in and year out. What I mean is at the end of 10 years, it ought to have averaged every year more than he's drawing out. And so it takes a little bit of work to go through that and do that. I mean, the only other option that he has, which to me is not really an option, but there's a part of it anyway, is you could take it all and you could put it into a charitable gift annuity, and he could get that income and get it for the rest of his life, and he'd never have to worry about running out. But I wouldn't want to see anybody take all that, all the money. So to me, I think that he should he have some charitable gift annuity? Yeah, I think everybody should, as a part of the portfolio that I just mentioned. So you've got, some utilities, you've got some growth stocks, you've got a little bit of charitable gift annuity, you got a little bit of, oil companies and so on and so forth. So I think the only way you get it to be able to maintain the principal, to maintain liquidity so that if something happens and you need it, you can get to a little bit of it if you have to, is to just really diversify, in a really good way. I would not trust one product. And that's what these annuities are. They're a product. They're an insurance product to do it.
Okay. Well, thanks for your advice.
Yeah. The best thing you can do for him, Leonard, is just try to steer him away from that and give him, ask him to ask what I told you there. Let me go to Joseph in Ohio.
Hello?
Yes, Joseph?
Yes, I was reading an article in Drudge Report about a company that is building homes in Egypt in a tune of $40 billion for the next 12 years, and they were talking about that company. So I did a little research, and I found out the company is from one of those Arab countries in Persian Gulf. I think either Dubai or maybe Kuwait, and the name of it is Arab Tech, ARABTEC, and the Drudge Report was saying that the value of the stock is increased by 70% since this January. And I tried to find out if I could invest some money in it, and I found out that they may not be traded on the stock market here. So I was wondering, do you know how a person can invest overseas without going through Dow Jones or normal channels here?
Yeah, they don't, by the way. They don't trade on any of our exchanges here in America. So what you need to find out is what exchange they trade on. So the first place I would start is probably the Toronto Exchange. So I would try Toronto Exchange and see if they are trading on the Toronto Exchange. If not, then you've got to trade in whatever exchange they're trading, and it becomes very difficult. It's hard to set up the accounts. You can set up a Schwab account that deals in. They have a Schwab account that will trade that stock. It's strictly an international account, and you can. They will trade it on whatever, and probably it's trading on the Dubai exchange, but they will trade it for you, so you'd be able to buy it. There is obviously some tax, ramifications with profits and things like that you make that are going to be a little different than if it were an American company, an American exchange. But nevertheless, the best way to do is check a brokerage firm. Maybe you already have a brokerage firm. If you do, you can check with them. I know Schwab has a platform for you to do that. They might have some monetary limits on how much you can trade. But that's the best thing I can tell you. So hopefully you'll get some information. Check out Schwab and do the research. You'll find out what exchange it's trading on if you want to try to go do a direct exchange. But you need a platform, and it's probably going to have to be Schwab or UBS or one of those type of exchange funds. Anyway, I want to thank everybody for being with us. It's Friday. We'll be back Monday. Got a fair amount of economic news coming out next week. It'll be an interesting day, not to mention all that's going on in the geopolitical side. So we'll talk about that on Monday, folks. Remember, all that we have has been given to us from God. Let's stand before him someday and be found a good and faithful steward. Have a great day of worship on Sunday. God bless.
If we ever forget that we're one nation under God, then we will be a nation gone under.